All right, so we are getting started on the next video for this chapter. We left off on sales returns, and we're jumping into the next learning objective and some of the transactions, how they affect net purchases. Okay, so we talked about freight in and freight out a little bit. Remember, when it's freight, when they're paying for shipping coming in, it's an inventory cost. Any freight going out is a selling expense. Okay. That going out is not put into inventory. Okay. Purchase returns depends on if you're periodic or perpetual. Like we've said, most businesses are perpetual. So they're going to have a reduction in inventory if they return something. If they are in a periodic system, they have this account called purchase returns, which acts like a temporary account. And it would go into that journal entry at the very end of the year. It would factor into the cost of goods sold. Okay, so um, here they give us an example of some purchase discounts. Remember, purchase discounts and sales discounts read exactly the same. Okay, so these terms could be put in a sales transaction. It would still mean the same thing. 2% if paid in 10 days, or the net is due in 30. Okay. It can be either done with the gross method or net method. Okay. I like the gross method better. I don't know why. I think it's just because the principles book for 20 years, that's all it ever did. So that's what I used. And, I knew I had to teach both methods in intermediate, but I taught gross method for a long time in the principles books. And then all of a sudden, like one year, I was kind of in shock because it did the net method, not the gross method. Okay. The gross method means we're going to start off. It's not really that we're assuming we won't take the discount, it's more just the assumption of this is what we're going to record it as. Both of them are GAAP methods, so it doesn't really matter which method is used. Okay. I like the gross method because if they don't take the discount, we don't have to do anything else. Okay. If we do the net method and they don't take the discount, we have to make an extra entry. Okay. So you can see they went ahead and took the 2% out of the 20,000. That's how they recorded it. They're assuming that they're going to take the discount. Okay. And I would say use the net method if if they're pretty consistent and always going to take that discount, which they'd be crazy not to. 2% in 10 days, that's crazy amount of annual interest if you think about it. Okay. That's just 2% in 10 days. Okay. If you annualize that, that'd be ridiculous for you to not take that discount. Okay. So here with the gross method, they took the discount out. See the 200 and okay. So they took 14,000. Oh, they only paid 14,000. I was like, where did that come from? Because it was 20. So 14,000, they paid 14,000 of it less the 2% discount. Maybe they didn't have the whole 19,600. So they took some of it and then the rest of it won't get a discount. Okay. So moving on. When they did not take that discount on the net method, they had to go back and put it back in, and they called it purchase discounts lost. Again, that's a temporary account that we will adjust in that end of year entry for periodic. Okay. All right. So let's skip those again. You can pause the video and work those if you would like. There's the answer. I think you have so many multiple choice questions in your test bank that I don't know that you're in any short supply of those. Okay. All right. So I don't want to work this problem. I have a huge problem that I'm fixing to do. Let's see. It's not this one. I'm going to kind of skip this one because I'm trying to uh, be concise and not let this video go on for 30 minutes. Okay. So this is the information we are going to use. Okay. We're going to do this 6 different ways. I know you're like, you're going to put 6 different ones in one video, Miss Solano. Yes, I am because I already have all the numbers in front of me. So I don't have to really do a lot of calculation as we go through these. Okay. So I got my little piece of paper here. we're taking this. This is what I said in the previous video. I have this as a Word document with all of this in each one of those. Okay. So we're going to take this information and we're going to do FIFO, LIFO, and average cost for perpetual. And we're going to do all of three of those for periodic. Okay. I'm going to do FIFO perpetual, FIFO periodic. I'm going to do it like that so that you can kind of see as we're going through them. Okay. And there's a couple of similarities that I'm going to kind of point out. It does help when we do it that way. Okay. So I'm kind of skipping several slides that this information is on. I actually got this information, this little page right here I got from the book. I just went to the book and snipped it out. Okay. So we're going to do FIFO perpetual first. All right. Oh, sorry. I was trying to get something off my screen. All right. So we're going to do perpetual. This is very similar to what we did in Principles of Accounting 1. Um, I would suggest putting your pencil down and watch me. Pause the video and then write everything out, okay? So watch me as I'm doing this. I know you're not technically right here in front of me to do that, but I'm going to suggest it anyway. All right. So remember perpetual, we're constantly keeping up with how much ending inventory we have. So for this very first one, beginning inventory, we're going to bring that beginning over here, the 4,000 at 550. Okay. We're going to come down here to January the 10th and we're going to sell 2,000 units. We only have one layer to pull from, so all 2,000 units will have a cost of $5.50 each. And I'm going to go ahead, I've got the number, I've already multiplied that out. That leaves me with 2,000 units in ending inventory at 550. Okay, so now we've got another purchase. See, notice we're gradually bringing this down, this ending inventory down. So when we get to the bottom, all we need is what's in the last one here. Okay, so we're going to bring our 2,000 at 550. We're going to add another layer of 1,000 at $6. Okay, we're going to bring those two down, and I've got to get three on one line. So we have 2,000 at 550. We have 1,000 at 600, and now we have 3,000 units at $7 each. All right, so now we get to a sale. Okay, we're going to sell 1,500 units. Okay, we're doing first in, first out. The first layer is that 2,000 at 550. So all 1,500 units will have a cost of 550. And if you multiply that out, you get 8,250. Okay, so that 2,000, almost all of that layer's gone. I'm going to kind of go over here because my layers are getting to be a lot. So I'll have 500 from that first layer at 550. I still have 1,000 at 6 and the 3,000 at 7. Okay. I'm going to purchase more inventory. Okay. I think since I've run out of room, instead of writing all of those, I'm going to just add it right here. And this right here will be for both of these blanks. Okay, if that helps, because I'm running out of room. Okay, so we have all these layers. We have to keep them in order so we know which layer to pull from first. So we come down here to the very last sale of the year, and we're going to sell 3,000 units. All right, 500 is going to come from that first layer. So 500 at 550. We need another 1,000 at 6. We got 1,500. We need another 1,500 from that $7 layer. Okay, so if you multiply these all out, you get 2750, 6,000, and oops, 10,500. All right. So what we have left, because we used all of that layer, and we used part of that $7 layer. So what we have in our very last one will be, I'm going to take that box out so you can kind of see. We have 1,500 from that layer. We took 1,500 from the 3,000. So now we have 1,500 at 7 and 3,000 at 750. Okay. We're only going to look at the very last one. We're going to look at the 15th because we've been gradually bringing inventory down. So we only look at what we have left in the very end. 3,000 times 750 gives us 22,500. Okay. If I added up everything over here in my cost of goods sold column, I should get a total of 38,500. My ending inventory should be 33,000. Okay. Ending inventory, this goes to the balance sheet. Cost of goods sold is going to go to the income statement. Okay. All right. So y'all might actually like periodic because there's a lot less calculation in periodic. So we're going to take these exact same numbers. That's why I did all this typing up of this so that you could have all this in front of you and you can compare them all together. Okay. So now let's do FIFO periodic. Okay. My chart looks a little bit different because we're not keeping up with it. Okay. We get to the very end. We're at December 31 and we see that we sold right here. We sold, I did that math wrong. I should look at my paper. We sold 6,500 units. Okay. So we're going to come over here and pull from those layers. Okay. Our first layer is 4,000 at 550. I'm going to go ahead and multiply it out. Gives us 22,000. So that layer's gone. I need 6,500. So here's the next layer, 1,000 at 6 gives me 6,000. That layer's gone. What do I need? I need 1,500 more units to get to my 65. My 65 has to be right there. I have to get 65 units. Those 1,500 will be at $7 each. If you multiply that out, you get 10,500. And then what you have left in, sorry about that, in ending inventory is everything else. Okay, ending inventory has 1,500 at the $7 level because we took 1,500 out of that layer. Okay, we'll multiply that out. It gives us 10,500. Now, if you're thinking to yourself, Miss Solano, those look like the same numbers. Like, aren't they going to be the same? Well, they are. Ending inventory ends up to be 33,000 total. And you're like, why did you do all this work? Just to prove a point? That's it. But this is the only inventory method that this will work on. Okay. FIFO is the only one that will produce the exact same results between perpetual and periodic. Okay. It was just a tiny bit different. We split a layer out, but it was still the exact first layers that we pulled from first. Okay. So notice periodic was a lot simpler and a lot faster. So on a test question, if you're asked to do FIFO perpetual, just do periodic because it's going to be the same number and you're going to get through the problem a lot faster. That was something I learned when I was studying for the CPA exam. All right, moving right along. We're going to do LIFO perpetual. I got another chart here for you. Okay. So again, if you wanted to pause the video, that'd be fine. We're going to bring that ending inventory over here, that 4,000 at 550. We're going to sell 2,000 units because we only have one layer to pull from here. So you'll notice this will be the same every time. Okay. And we're left with 2,000 at 550. Okay. So we're gradually bringing that down. We're going to add another layer to it. We're going to bring that 2,000 layer. I'm not multiplying these out just because I don't really need them to all those ones for ending inventory. Plus, I've got too much writing going on. If you did it in Excel, it'd be super easy calculation or, a formula to write. Okay. So we're taking that 2,000 down. We're going to add another layer of 1,000 at $6. So we have two layers now. Now we're going to add another layer because we have another new purchase. So I'm going to squeeze all these in. And we have 3,000 at $7. Okay. We come down here to the 15th. Here's where it's going to change. We're pulling from the last layer. Okay. The last layer is the 3,000 at 7. So 1,500 units will have a cost of $7 each. If you go ahead and multiply that out, you get 10,500. So we took some of that layer. So we still have 2,000 at 550, and we have 1,000 at 6, and we have 1,500 at 7. And I'm going to do it the way I did earlier, just like kind of combine these two together because I'm running out of room. It's going to be the same whether I write it here. And then I'm just going to add this new purchase of 3,000 at 750. All right. We're going to come down here to the very last sale. All 3,000 units will come from that last layer. Okay. So our ending inventory will only have 3 layers. I think it only had 3 layers before. Notice that we have the exact same units in each one of those ending inventories. The thing that is different is the dollars that are following each one of these inventory items. Okay. And you'll start to see a difference here, especially LIFO usually produces a really big difference between cost of goods sold and ending inventory. If you totaled up all of the cost of goods sold, you should get 44,000. Notice that it's a lot more. The reason it's a lot more, notice we're in an inflationary period. Those items we had bought them in the previous year for $5.50. 10 months later, they've gone up $2 each. This only works in a period of inflation, which most of the time we have. Okay. So notice the cost of goods sold is a lot more because you're pulling from the last layers, and usually the last layers are the more expensive ones. Okay. So if we multiplied these out, we have 11,000, 6,000, and 10,500. If we totaled all those up, we should get 27,500. Okay, we're halfway there. If you want to pause the video and write that down, I'm fine with that. I mean, I'm not going to know if you pause it or not. All right, so now we're going to do LIFO periodic. Okay, again, we still have 6,500 units, but we're going to pull from the last layers first. On that other one, we started way up here. And it doesn't matter, like we probably didn't know we were going to sell this many when we purchased these, but we look at it as we knew all along when we were purchasing and selling things. Okay. So, going to get the 6,500. The first will pull from the $3,000 layer. at 7. If you multiply that out, it's 22,500. We're going to pull from the next layer, which was 3,000. Oops, I did something. I did not do 750 there, but my 22,500 is correct. And then that gives us 2,100. I'm sorry, 21,000. We have 6,000 between those two layers right there. We need 500 more units. Those 500 will come right here. So it would be 500 at $6. If you multiply that out, you should get, I think it's 3,000. I can't read my own handwriting. Okay. What's in ending inventory? We have 4,000 units at 550, which is 22,000. We have 500 units from that layer at $6. Same exact concept. We are pulling from the last layers first, and those last layers cost more money. Okay, so you should get 25,000 for ending inventory, and you should get a total cost of goods sold of 46,500. All right. Again, you can pause the video if you want to. We are moving right along. There is more calculation when it comes to weighted average. Okay. Because every time you have a new purchase, you have to calculate a new average. Okay. So let's start this off. It's going to look exactly the same as the other three because we're just going to bring those 4,000 units over. We only have one layer to pull from. So 2,000 units at 550. Okay. 2,000 units at 550. That leaves us, and we've had this exact same number every single time right there. We're going to have ending inventory of 2,000 at 550 because we pulled 2,000 from that right there. All right. We are going to bring that 2,000 down again, and we're going to add another layer. Add another layer of 3,000. I'm sorry, 1,000. I think I did that when I was working this out. I skipped that 1,000 level or layer. Okay. And we're not going to do that right there because we're not going to have layers with weighted average. So we're going to come down here. I should, in your Word document, you should have an extra page to do these calculations. So I kind of tricked you there. Sorry. So we have this layer of 2,000 at 550. We're going to multiply that out to get 11,000. Okay. Now we have a new layer coming in of 1,000 units at $6. Okay. So multiply that out and you get 6,000. Okay. We're going to add these up. We have a total cost of 17,000 across 3,000 units. So we have $17,000 divided by 3,000 units, and you should get around $5.67. So when you come back up here, you don't have layers anymore. It'll be easier for me to write it. You will have 3,000 units at an average cost of $5.67. Okay. Now we have another new layer coming in. So we had 3,000 units at 567. We can go ahead and multiply that out because we knew it was 17,000 from right here. We're going to bring in this new layer. I think it's 3,000 at 7. 3,000 at $7 each. Okay. And if you multiply that out, you get 21,000. You're going to add those up. You get a total cost of 38,000 over total units of 6,000. So if you take the 38,000, divide that by 6,000, you should get $6.33. Okay. So here we're going to say we don't have layers anymore. We've smushed the layers together. That's my very technical term. Okay. So we have 6,000 units at an average cost of $6.33. Okay. So now we're going to sell 1,500 units. It's super easy because we only have one layer to pull from. We now have those 1,500 units all have an average cost of $6.33. And then we will be left with 4,500 at $6.33. Okay. We have another new purchase, so we have to calculate one more new average. Okay. So we will take, come down here, I've got a little white space here, 4,500 units at 633. And we have another layer coming in of 3,000 at 750. We're going to multiply those out. We get 28,500, 22,500. If you total those up, you should get 51,000 over 7,500 units. You'll calculate a new average cost. 51,000 divided by 7,500 will give you $6.80. All right, so we're going to come up here. We've smashed those layers together. We now have 7,500 at the $6.80. Makes the sale super easy because they all have an average cost of $6.80. And then that leaves us 4,500 with an average cost of $6.80. I gotta go back and flip my page back over. So if you multiply this one out, you get 94.95. And that last one should be 20,400. And you add those up and you get 40,000. I got 40,895. The book rounded it to 40,900. Some of the problems I think will probably tell you how to round if that's an issue. Multiply this last one out and we should get ending inventory of 30,600. We're almost done. All right. So that's a weighted average. Sometimes they call that a moving average. Notice how the average changed every time we bought a new layer of merchandise. Okay. So now we're going to come down here to average periodic. Okay. So we can take all of these purchases, multiply them all out. We're going to get one average and apply it to all 6,500 units. Okay, that totals up to be 71,500 with a total units right there of 11,000. Okay, we're going to take the 71,500, divide it by 11,000, and we get an average cost of $6.50. Okay, we sold 6,500 units. We'll take the 6,500 units, multiply that times the $6.50. This one y'all are going to love because it's really easy. 42,250 is our cost of goods sold. We have 4,500 units left over. Apply that average cost, $6.50, and you'd end up with 29,250. I won't do it in this video. In another video, we'll compare all of these. One thing to be mindful of, we were in an inflationary period, okay? If we're in a deflationary period, the opposite happens, okay? probably the one that's going to be the most calculation is that weighted moving average. Okay, we'll compare all these and look at them in the next video, but I'm going to cut you free on this one. I'll see you in the next video.